Greetings, traders. It is I, Abdul Shabazz, and this is some real change stock options trading journey. And today, this wonderful Wednesday, April the 16th, A'udhu billahi minash shaitanir rajim, bismillahir rahmanir rahim, as we begin today. Thank you for joining us and being a part of our journey as we prepare to find profits in the charts. I'll be sharing my plans here shortly. And today we do have Jerome Powell speaking at 1:30. Good morning, Dr. J. Good morning to Lance and Brooke Sanchez. Great day. Trade Dilla. Top of the morning to everyone. Happy hunting, traders. Trade Dilla is in the building. And if anybody would like to share their plans, please feel free to do so. We do have a 10 o'clock report coming out, business inventories. But the big thing is at 1:30 when Jerome Powell will speaks. So let us prepare today for a wonderful potential opportunity as Todd Macon enters the building now as well. Have no idea what the market is going to do, but it's definitely going to do something on this wonderful Wednesday. I'll go ahead and share my plans with the guys and the girls. Today, Wednesday, April the 16th, I'm interested in a 540 call. I'd like to take that to the 544, possibly the 545. If we continue to go down, I'm interested in a 530 put, taking that down to the 524, possibly the 521, maybe even the 515. That's right. You heard me say it. Additionally, with that, I will be using a next day. I will not be using a 0 DTE on a position like this. So those are my plans. If you have some, please feel free to share yours. Once again, for the people in the back, if I need to adjust, I will. But for now, I'm looking at that 540 call and a 530 put. Sale of 58 is in the building as well. Bismillah as we begin today. On the 30-minute chart, I wanted to show Friday as well as Monday, as we are in that area of trade once again, showing the potential downside. Being ever so cautious. That market did drop to 531.4 area and has since bounced from that 531.4 all the way to 533 in this first 5-minute candle. Nice move to the 534 where there is resistance there. Looking here on the 30-minute chart. Interesting to see how the market will respond in this area. This could be quite a bit of liquidity if this turns from a green to a red move. Quite a bit. It's 30-minute view. Great day, great day, great day. Grateful day. Grateful day. Grateful day to you, traders. Grateful day to you, visitors. Grateful day to those of you who watch the replay. We are so grateful and thankful for your participation in adding value to this channel, adding value to this group, adding value to this vision. It's 9:40. It's a great time for a cuppa as we allow the market to do what it does. Possibly we might get a nice move this morning. Majority of people will be waiting for Powell. So let us apply a little grain of seasoning to our reasoning. We will be all right. This wonderful Wednesday. I do have news up on the side, but the big news today is Powell speaking. Does anyone else know of anything that is jumping off today? Yeah, they took it out. Well, hello there as she goes red on the day. Will she hold? No one knows. battling back. You see the bulls rejecting lower prices. Right where my alarm went off, the bulls started jumping in and buying. Definitely did not want the candle to close below this area. It's going to be a great day. It's going to be a great day. I'm going to just sit back, relax, and let's allow the day to come to us. If anybody sees anything, the chat is completely open. I'm going to just sit back, relax, and allow a trade to come to me. But in order to do so, I'm going to have to first identify someone who may be in trouble. And if I don't see anybody in trouble, that means I might be the one in trouble. And definitely don't want that. As we are once again on that 531.5 area, attempting to go red on the day very early. Very early. This could be some pressure. A nice break and a retest is what would always be best. Sit back, relax, and let the chart do the talking. Looking at the clock, I will take some profits towards the end of this 5-minute candle. Took some initial profits right there. Nice potential liquidity move to push down towards that 529.6 where my alarm is. Knew that we would need a little help to get down there. So knowing that that would be the turning point, I took profits here the first time we reached here. Allow the market to bounce and breathe. And I'm now looking for that 529 potential break. Beautiful strategy executed on that. $10 candle, very important. Very important $10 candle. All right, got out of that last position as the market is finding some support here at that 529.8. We'll gladly be on the other side of it if she decides to come on back down. But I took the profits as they presented themselves to me. Very solid trade. Very grateful for that. Still very early. But if we look to the left, simply on the 30-minute chart, we see that the market does have the tendency to find support at this area. So the risk was worth the reward, holding on just a little longer to see if we were going to break this very tender area. But seeing that we weren't, I took the profits as they presented themselves, and being that I took them from as high as the 531.5 on that break, very, very well pleased with this morning's trading. Looking for another opportunity if one does present itself. If it doesn't, I understand, as Powell will be speaking today. And I said, if the market does give us an opportunity this morning, that would be great. If it doesn't matter. But very happy with that opportunity. And again, as we look on the 30-minute chart to our left, we see that the market does find support in this area. We just have to be patient to see if she does retrace. If she does retrace, that will be quite a bit of liquidity that will be used to take the market a little further down. So I'm going to go ahead and put an alarm there. Okay. And this actually coincides with my original plans, guys, as I shared them this morning. My original plan was to take a put, okay, a 530 put, but my original plan was to get in at the 529.4, and we actually hit that 529.5 and bounced. So my original plan was to get in here. I just saw an earlier opportunity to be able to get in at that 531.5, and so I took that. But patience allows me to go ahead and reset this alarm and look for that opportunity to take that 529.4 all the way down to the 524, possibly the 521, and even possibly the 515. That's right, I said it. Anything is possible on a day like today. Grateful for this morning's opportunity that it yielded itself. And I will be adjusting my call from the 540 call, which I originally had. Okay. Bringing it back down now to the 534 is the new adjustment on the call. Seeing a break and retest of that area would be a great indicator for me. Seeing a break and retest of that 534. I have an alarm set at the 534.18. As we look left, we can see that if the market is able to get over this area, not just with confirmation, but with continuation, and she failed here the last time she was there. We got confirmation, but failed continuation. And here we love confirmation and continuation. It's very early, a lot of trading day left, and Powell is speaking today. So, as our buddies over there at Shirts for Traders always remind us when Powell is speaking, they have a shirt that says, pretty much sums it up. Here it is right here. Pretty much sums it up when Powell is speaking. Head on over there to Shirts for Traders. Pick you up one of these lovely, lovely shirts with fast shipping. Awesome, awesome. Again, this is taking a step back, looking at the larger algo here, which is the 30-minute. There is still a lot of possibility for downside and a lot of liquidity now to make it happen. The upside battle is going to be a hard one. As in this candle, you have a lot of bears. Bears who have rejected higher prices. And that's what made the put so easy to take, because we had a flip of a candle from a green to a red move, as I spoke about this potentially happening on the daily chart as well. Spoke about that flip from a green to a red move. The market is now attempting to move back. But right now, representing a state of indecision, slightly bearish. A lot of day left in today. Trade your rules, not your emotions. And if your rules calls for you to trade your plan, then do so. For those of you who are wondering what setup did I see to make me take this put, this was a break of demand setup that I saw to make me get in this put. Even though I called out on paper the break of the 529.4 area, which will be absolutely lovely if that does take place, as the market has built some very nice liquidity to take it down. And it has come right back to that area that I showed you as the break of demand. It has now come back and tested it once and twice, right back to that same area. So initially, when I saw the break of the area, I did not hesitate to pull the trigger. It was my duty, obligation, and responsibility to take that shot. So I took it. And as we have now bounced back to that area, it also represents a lot of liquidity that could be used to go higher if you make these 950 bears that I was once a part of a little uncomfortable. They might be holding on for a much larger move. Unlike myself, I don't like roller coasters. I took my most profit when we reached the lowest level rather. Took the remainder when I saw she wanted to bounce from that. Let her do what she's going to do now. Catch her when she comes back down. Catch her when she squeezes the bears that are still hanging on. Either way, it's time to sit back and let the market do what it does. Great time for a cuppa. Thank you for hitting the like button. The chat is open.
$7,000. What is $7,000? What do you do? What do you do? What do you do? 7. So 67.50. 269. 269. All day, gentlemen. Good as one.
I don't know, 8 miles. What do you be? What do you 6, 7? We're going to be 172. 172.
Have you seen this? It's absolutely insane. Look at the presentation on what's inside this can.
Alrighty, G County Boys is in the building. Thank you so much for tuning in. Let me go ahead and back things up just a little bit so I can give you a brief rundown on what you are looking at. What we have up is the SPY, and we just have different views of the same instrument, the same ETF instrument. In the top right, we have the daily chart. In the bottom right, we have the weekly chart. And we love to have those two up, so therefore we can, number one, look to see who has overall control of the week, and then look and see who has control of the day. So even though this is a bullish day, we do realize and understand that the bears do have control of the week. So any bullish move, please believe it could be met with some form of bearish push down, as we're currently seeing right now. In the middle, we have the 30-minute chart. And we love to look at the 30-minute chart because sometimes you just need a different view of the same instrument. Sometimes you can look at it up close. Sometimes you need to take a step back. To the left, we have the 15-minute chart. And the top left, we have the 2-minute chart. Sometimes we do switch to the 1 minute as far as our entries. But right now, we have it on the 2-minute Heikin-Ashi, looking at the overall flow of the market. And then we have the 5-minute chart in the middle. BFH is in the building, checking in from work. Thank you for checking in as well. Knowing that today's fireworks are probably going to begin to take off around a little 1 o'clock this afternoon, as we have Jerome Powell speaking today. Until then, you can expect a little bit of uncertainty, a little bit of choppiness. You know, as Brooks said, looked like a whole bunch of chop today. But we are grateful that you guys have tuned in. And so this is typically what we're looking at overall. Again, the same instrument, but a daily version, a weekly version, a 30-minute version, 15-2, and then a 5 in the middle that we generally look for our setups off of. We've also identified a controlled selling algo that the market is currently within. This could be used as liquidity to take the market higher if they feel that we're having this too much resistance at this 534.5 area, as we saw a very nice shooting star put in at that resistance level, and then the market has started to come down since then, putting in a morning high of 535.15, and we're now trading at 533. So the market has definitely pulled back from that high. As well on the daily chart, showing us a little bit of indecision by way of putting in a doji right now. The daily candle is that of a doji, a little bit of wick above the candle body, a little bit of tail below the candle body. Slightly bullish, but still a state of indecision. Can be expecting that on a day like today when Powell is speaking. If you're able to see a clear move based on proper risk management, go for it. Other than that, looking at the bigger picture will begin with Powell speaking in the Q&A at 1:30. We have live commentary, G Country Boys, from 9:25 a.m. to 11 o'clock. And then at 11 o'clock, we then go ahead and turn the chat over to the crew, coordinated by our very own Brooke Sanchez. Any questions, suggestions, plays that you may see, feel free to put them up. You may hear my voice, but this is a complete team effort. So anything that you say, we will read out loud with the intentions of being a benefit to all. And then as you got on right now, all I simply did was have the 5-minute chart blown up after identifying at that VWAP level. Also, for clarification, the purple line indicates a monthly area of support or resistance. Red is regular resistance. Green is support.
find itself in a of low employment and low inflation being in tension, in some form of tension, because of higher inflation and slower growth coming from the tariffs. In that conflict, the Fed chair says, between these mandates, the Fed will judge how far the economy is from each goal and the time it would take to get back to the Fed's goals in those scenarios. The Fed, at this point, he said, is well positioned to wait for greater clarity before considering any policy changes. The tariff increases, as he said back in April 4th, are significantly larger than anticipated, and so the economic effects will be larger as well. Tariffs are highly likely to generate at least a temporary rise in inflation, but he goes on to say that the inflationary effects of these tariffs could also be more persistent. Keeping inflation expectations well anchored, that's going to be the key for the Federal Reserve and the key to avoiding any persistent ongoing effects from tariff inflation. On the economic outlook, the Fed chair will say that the data suggests so far that growth has slowed in the first quarter, with consumer spending growing only modestly. He does take note of the strong imports we've seen, the front running, reflecting businesses front running tariffs as well as consumers when it comes to purchases. Those imports will weigh on GDP. Households and business surveys, he says, show a sharp decline in sentiment, including elevated uncertainty, largely reflecting trade policy. And despite all this heightened uncertainty and downside risk, sees them very well, and the core at 2.6. So, Wilf, it looks like at least the numbers right now show inflation under control, but of course this could be the calm before the storm. Wilf?
Steve, stick with us because I want to get your take on exactly what we should take from those. I just want to mention the market hit session lows there. During you breaking that news, Steve, we're down 1.7% on the S&P 500. Let's go back to you then, Steve. I mean, you know this man better than anyone. To me, that said he's not doing anything preemptively. What was your take?
No, look, it's interesting that he did not echo the words of Governor Waller, who said, we'll probably cut in any event, right? So Governor Waller said if we have a temporary pass-through of tariffs, we'll cut. And he said if there's a big downdraft in the economy, we'll cut. Powell is not telegraphing that. It may turn out to be the case that the Fed finds itself in the face of these higher tariffs if tariffs are one time and if they end up having a sharp impact on the growth and employment scenarios. Yes, the Fed can cut, but the Fed is not telegraphing that, and neither have many other officials other than Governor Waller in this situation. And so the Fed is not promising the market anything. I think the way to think about the world right now, Wilf, is that there is no rate put from the Federal Reserve. There is, however, probably a liquidity put if there tends to be a need for that. But right now, Powell is not guaranteeing you anything until he sees whether this tariff problem ends up being a broader and more.
I am standing on the side,
Tom,
team. I'm standing on the sidelines.
3 rate cuts this year. You going to stick to that?
So far, yes. Me, just like all the Fed officials, Powell included, don't have much to go on that is going to give you a specific path for rates beyond a certain sort of vague framework, right? So I do think that there is some possibility that we'll get weaker employment data in the next few months. Currently, I had the cuts in June, July, and September, but as with all forecasts, once you get closer and closer to when you think those things are going to happen, you realize how much more sort of needs to fall in place before you're going to get there. So at this point, I think there's some chance it gets pushed out a little bit, but I do think that, reading between the lines of Powell's comments there, he's saying that there will be a period of time in between where it's not clear what they're going to have to do. And then at some point there will be, a weight of one thing versus the other on the dual mandate, and employment, I think, is going to win the day at the end of it.
Matt, I know we spoke about your position in gold. I know you like some overseas stocks as well, and I guess a lot is linked to that is what the dollar's doing. What do you make of these comments from the Fed chair, and does it alter your perspective about domestic versus overseas?
It doesn't really alter the perspective, because I think that policy bind that the Fed found itself in coming to this year was that unemployment was below average, and wage inflation, while it had moderated, was still above the average of the last couple of decades. And so you had a situation before the tariffs that if earnings were accelerating for the S&P 500, payrolls could actually reaccelerate, and that could put upward pressure on prices. Now we have this shock. it's not just a short-term shock in terms of backdoor consumption tax, but supply chains will have to change at the margin, and that's a longer-term supply adjustment that needs to go on. Further to that, one of the things that policymakers will find hard to calibrate here is that dramatic declines in immigration rates are going to slow the growth rate in the labor market. And so there are a bunch of different considerations here. As we've looked at the world, we felt that some of the policy uncertainty was better priced outside the United States. Earnings multiples
Matt, forgive
in
me
Europe.
for interrupting, because Jay Powell's taken to the stage. Let's listen into what he's got to say.
And thanks for that kind introduction, Austin. So I'm looking forward to our conversation, my conversation with Professor Rajan Raghu. But first, I'll briefly discuss the outlook for the economy and monetary policy. So, at the Fed, we are always focused on the dual mandate goals that Congress has given us. Maximum employment and stable prices. Despite heightened uncertainty and downside risks, the U.S. economy is still in a solid position. The labor market is at or near maximum employment. Inflation has come down a great deal, but is still running a bit above our 2% objective. Turning briefly to the incoming data, we'll get the initial reading on first quarter GDP in a couple of weeks. The data we have in hand so far suggests that growth has slowed in the first quarter of this year from last year's solid pace. Despite strong motor vehicle sales, overall consumer spending appears to have grown modestly. In addition, strong imports during the first quarter, reflecting attempts by businesses to get ahead of potential tariffs, are expected to weigh on GDP growth. Surveys of households and businesses report a sharp decline in sentiment and elevated uncertainty about the outlook, largely reflecting trade policy concerns. Outside forecasts for the full year are coming down, and for the most part, point to continued slowing, but still positive growth. We are closely tracking incoming data as households and businesses continue to digest these developments. In the labor market, during the first 3 months of this year, non-farm payrolls grew by an average of 150,000 jobs per month. While job growth has slowed relative to last year, the combination of low layoffs and lower labor force growth has kept the unemployment rate in a low and stable range. Meanwhile, the ratio of job openings to unemployed job seekers has remained just above 1, near its pre-pandemic level. Wage growth has continued to moderate while still outpacing inflation. Overall, the labor market appears to be in solid condition and broadly in balance, and is not a significant source of inflationary pressure. As for our price stability mandate, inflation has significantly eased from its pandemic highs of mid-2022 without the kind of painful rise in unemployment that has frequently accompanied efforts to bring down high inflation. Progress on inflation continues at a gradual pace, and recent readings remain above our 2% objective. Estimates based on the most recent data from last week show that total headline PCE prices rose 2.3% over the 12 months ending in March, and that excluding the volatile food and energy categories, core prices rose 2.6%. Looking ahead, looking forward, the new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. These policies are still evolving, and their effects on the economy remain highly uncertain. As we learn more, we will continue to update our assessment. The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs. Survey measures of longer-term inflation expectations, for the most part, appear to remain well anchored as well. Market-based break-evens continue to run close to 2%. So, as we gain a better understanding of the policy changes, we'll have a better sense of the implications for the economy and hence for monetary policy. Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. As that great Chicagoan Ferris Bueller once noted, life moves pretty fast. For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks. We understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. We will continue to do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to our discussion.
Okay, guys, we got a panel discussion coming up next.
Thank you very much, Chair Powell.
A panel
for those
discussion.
remarks.
Yeah,
look
Brooks, I got it
forward
up on the
to
screen.
Your elaborating on them.
You can actually
of course,
see
in the
what
next
everything
40
is doing. The
minutes or
Dow,
so.
the S&P,
I
the
understand last time you
composite,
were
the
here,
Russell.
Melody Hobson
Got it up on the
interviewed
top
you.
left.
Well, I'm a poor substitute, but I'll try and compensate in the quality of the questions.
This is the panel discussion that's happening right now,
As
guys.
you repeatedly emphasize, communication and transparency are very important for the Fed. I would like to get more from you on some of what you just said. As a former central banker, the only sort of caution I've been given by the Economic Club is to not lapse into central bank speak. So I'll try my best not to do that. Let me start by saying you've guided the Fed through some really difficult events, including the pandemic, the dash for cash in March 2020, the great inflation, the banking crisis centered around Silicon Valley Bank. And then over the course of the last year, we've seen a growing possibility of a Fed-engineered soft landing. And now it seems like everything has changed. In the course of a couple of months, JP Morgan has shifted to estimating the probability of a recession this year at around 60%. What do you think about all this?
Well, first of all, thank you for being here today. It's a pleasure to be here with you. Actually, the appearance I did here was my very first appearance as chair 7.5 years ago, so it's great to be back. And I would agree with you that it's been an eventful 7 years. Putting it mildly, I keep waiting for the 3 months of calm, that never comes. But to your question, I guess to set the stage, let's look back at 2024. 2024 was a year where the economy grew 2.4%. Unemployment remained in the low fours, close to mainstream estimates of maximum employment, and inflation came down and was running at the end of the year around 2.5%. That's the economy that we had, and I won't decide how to characterize that, but that's where things were. Where we are now, again to your question, is the administration is, as I mentioned in my
called a
remarks,
530
implementing
put,
significant
getting
policy
in
changes,
at the
and particularly
529.4
trade now
clear
is the
area.
focus.
Once we had the
And
bounce
the
there,
effects of that are
first
likely to
profit
move us
taking
away
area
from
is going to
our
be
goals.
524.
So, unemployment is likely to go up as the economy slows in all likelihood, and inflation is likely to go up as tariffs find their way, and some part of those tariffs come to be paid by the public. So that's the strong likelihood. And, you know, my hope is that we'll get through this and get back. Well, we're always going to be aiming for maximum employment and price stability. That's what we do. I do think we'll be moving away from those goals probably for the balance of this year, and then, or at least not making any progress, and then we'll resume that progress as we can.
Let's talk a little more about tariffs. I mean, you recognize that some of the effects of the tariffs will be one-off, transitory, but you also have said that perhaps they will give room for a number of firms to raise prices. You mentioned dryers. When washing machine prices went up because of tariffs, dryer prices also went up in tandem, even though they weren't tariffed. What's your sense about the effects of tariffs on inflation? What would make them more persistent? And what would make them have effects on growth?
So in a kind of a simple starting point is one tariff comes in that gets passed along in prices and raises inflation, but it's just a one-time thing. So the price level goes up, and that's it. But that can happen in some circumstances, but it depends on a number of things which we don't know yet. And I would point to a couple of them, or three of them actually. One is just the size of the effects. And as I mentioned, the tariffs are larger than forecasters had expected, certainly larger than we expected, even in our upside case. We looked at a range of cases. So that's one. The second one is how
look for the market to find some support here
the tariffs
at the
have
526
their effects on
area.
To the extent it takes longer and longer, that raises the risks that the public will begin to experience higher inflation. They'll come to expect it, and companies will come to expect it. So that risks higher inflation. And the third is just what I mentioned in my speech, which is my remarks, which
this
is
a natural area of
inflation
demand,
expectations well anchored.
which
So
is
if
why
we
the
have
market
those
is bouncing
three
here.
things under control, that's what it will take. And indeed, our role is to make sure that this will be a one-time increase in prices and not something that turns into an ongoing inflation process. That's a big part of our job.
What about the effects of tariffs on quantities? With the level of tariffs that, for example, have been currently applied on China, there's a fear that the supply chain may get disrupted, that firms may not be able to import their relevant stuff from China given the level of prices. If it turns into a supply shock, would the Fed's response be different than if it was primarily something which affected just prices?
So I actually had dinner at the Chicago Fed last night, and with a number of directors of various parts of the Chicago Fed, and many of them are CEOs of significant companies, and they this uncertainty that they're feeling and the issue with imported components to their products is just a huge issue. But with if you look back at the pandemic, if you remember, there was a shortage of semiconductors, and that led to a shortage of cars at a time of extremely high car demand. And it was a prolonged shortage because production couldn't keep up. And that led to an extended period, one of the things that led to an extended period of inflation. So when you think about supply disruptions, that is the kind of thing that can take time to resolve, and that can lead what would have been a one-time inflation shock to be extended, perhaps more persistent, and we would worry about that. In this case, you can look at the car companies, which their supply chains are likely seem to be on track to be disrupted significantly, and you would worry that that process will take some years and that the inflationary process might be extended. So these are all of this is highly uncertain. We're thinking now really before the tariffs have their effects, as how they might affect the economy, and that's why we're waiting really to see what the policies ultimately are, and then we can make a better assessment of what the economic effects will be.
Let's move to immigration. You talked about the labor markets being in reasonable equilibrium right now. Of course, what we've seen over the last few months, the last months of the previous administration continuing into this administration, is immigration has fallen off considerably. What's your sense on how that will affect the labor market?
So part of why growth was so strong in the last couple of years was just very high levels of immigration, and those people went to work. The economy hired them. There was a lot of demand. We were still working off the labor shortage. What's happened since the prior administration changed their policy, as you mentioned, immigration has fallen very sharply, and therefore the growth of workers has really stopped. It's really stagnant. But at the same time, demand has also fallen. And so demand for workers, so payroll job creation has also fallen, and they've kind of fallen in tandem, which is why the unemployment rate has been pretty stable for about a year. So in a way, demand and coincidentally perhaps to some extent, demand and supply for workers has fallen. In terms of the effect on the labor market, right now we're still at full employment, and labor force participation is still strong. Wages have moved back down to levels that are now pretty sustainable, given an assumption about productivity. So the labor market's in a really good place. Longer term, you know, the effects of immigration are not thought to matter much for inflation. The effects on demand and supply will more or less cancel each other out. So we wouldn't expect there to be a big impact on inflation.
You've seen in recent weeks substantial talk about layoffs in government, as well as freezes in research establishments and universities in jobs. How soon and how big will this be in its impact on labor markets?
So it's too soon to say, but what I can say is, of course, the people being laid off in government, this is highly significant to them. We don't know how big that's going to be. Right now, it's not big enough to affect a workforce of 170 million people materially. In terms of the cutbacks in funding and for science and things like that, we do see in areas, particularly in cities that have a lot of universities and research hospitals and research institutions, we're really hearing significant layoffs and significant impacts on employment. I don't know how much that will total up to. And of course, in addition, cutting back on scientific research may have implications for economic growth, for productivity, for health, for all kinds of things. But those are very difficult to estimate in real time.
Now, given that we're talking about the future, you may be confronted in the not so distant future with both higher levels of unemployment as well as potentially higher inflation. And of course, the policies that each one requires could be different. You talked a little bit at the podium about how the Fed would see these two and how it would address it. Just giving you a chance again to elaborate on that.
Right, so most of the time, when the economy is weak, inflation is low, and unemployment is high, and both of those call for lower interest rates to support activity, and vice versa. So most of the time, the two goals are not in tension. And they're not really in tension now. The labor market is still strong. But the shock that we're experiencing, the impulses we're feeling are for higher unemployment and higher inflation. And our tool only does one of those two things at the same time. So it's a difficult place for central banks, to be in terms of what to do. And so the best we can do is we actually have a little provision in our consensus statement, which is the thing that we vote on to embody how we approach these questions. What we say is we will look at how far the economy is from each of those two goals, and then we'll ask, might there be different paces at which they would approach those goals? We'll look at those things and think about them, and we'll make what will no doubt be a very difficult judgment. Again, we're not experiencing that now, but we could well be in that situation, as I mentioned in my remarks.
Just want to pick up on a word that is often used today, uncertainty. As a respondent to a Dallas Fed survey said, I've never felt more uncertainty about my business in my entire 40-plus years career. The worry today is not just about immediate policy uncertainty, but an entire change in the US's economic philosophy. Not just policy uncertainty, so to speak, but structural uncertainty. One of the effects, as you've pointed out, of higher levels of uncertainty is that firms postpone investment. For instance, even after the tariffs stabilize, firms that contemplate reshoring production facilities will hesitate, not knowing if the tariffs will be reversed in the future, maybe by the next administration. How do you take such longer-term uncertainty into account in your policies?
So let me just agree that what comes back very strongly, and everyone will understand this. These are very fundamental changes in, long held in some cases policies in the United States, and there's not any real experience. I mean, the Smoot-Hawley tariffs were actually not this large, and they were 95 years ago. So there isn't a modern experience of how to think about this. And businesses and households are saying in surveys that they are experiencing incredibly high uncertainty. There's a lot of research, some of it from the Fed, showing that does lead to businesses and households stepping back from decisions, which of course makes common sense. And you hope that that's something that you go through a phase, and then you know what things become more certain, and therefore people can resume normal economic activities given their understanding of what is the new normal. I mean, your question really is, what if the uncertainty remains high? I think that's a difficult environment. I think people's expected rates of return would have to be higher. I think people that would weigh on, to me, investment just in general. If the United States were to become a jurisdiction where risks are just structurally higher going forward, that would make us less attractive as a jurisdiction. We don't know that at this point, but I think that would be the effect.
Well, let me turn to financial markets. We've seen some volatility, especially stock market volatility. I mean, the levels of the VIX are up to the levels they were in the early days of the pandemic, coming off somewhat now. Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. So what I think is going on in markets is markets are processing what's going on. And, it's really the policies, particularly the trade policy. And really the question is, where's that going to come in? Where's that going to land? And we don't know that yet. And until we know that, you can't really make informed assessments that would still be highly uncertain. Once you know what the policies are, it'll still be highly uncertain what the economic effects will be. So markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning. Conditional on being in such a challenging situation, markets are doing what they're supposed to do. They're orderly, and they're functioning just about as you would expect them to function.
So we've seen volatility also in the bond market. And at a time when usually there's a flight to safety, we saw yields on the German Bund and the Japanese government bond come down, but we saw yields on US Treasuries go up. What do you attribute this to?
So I would just say the same thing. I think it's very hard to know in real time. I've had a lot of experience with significant moves, for example, in the bond market, where there's a narrative that people land on, and then 2 months later, you look back and go, that was completely wrong. So I think it's very premature to say exactly what's going on. Clearly, there's some delevering going on among hedge funds in levered trades and things like that. It's also, again, it's the markets processing historically unique developments and with great uncertainty. And I think you'll probably see continued volatility. But I wouldn't try to be definitive about exactly what's causing that. I would just say markets are orderly and they're functioning kind of as you would expect them to in this time of high uncertainty.
So the Fed in its last meeting slowed the pace of shrinking of its balance sheet. Was this driven by uncertainty about how much reserves and liquidity the market needed, and you wanted to take a little more time to find that out? And flip side, you said the market was orderly. What if market disruptions emerge? Would the Fed intervene?
So we think that reserves are still abundant. So we don't think we're close to the point, particularly close to the point where we would stop. But we were facing a situation in which, for other reasons, there were going to be big flows into and out of reserves as it had to do with the debt ceiling and the Treasury General account. For those of you who are Treasury market people, that'll make sense. But while those big flows are happening for over a period of 6 months, we would actually be shielded from being able to see evidence that we were or were not getting close to the level of less abundant reserves. And so we decided to slow the pace. We thought about pausing, and instead we debated it. It's one of these great debates that we have at the FOMC. We decided to slow the pace instead. And people really came to see the merits of that because, the slower we go, the less the smaller the balance sheet can get without disruptions. And we want that process to continue, and now it's at quite a slow pace. So we think that's a really good thing. So that means it can go on for a longer amount of time, and we'll be able to reach kind of very carefully what we think is the right level of reserves. Still plenty of reserves.
What about the international dollar-based system? With all these disruptions, do you stand ready to supply dollars to central banks as you've done in the past when there's been a global shortage of dollars?
Sure, absolutely we do. Just for everyone's knowledge, we have standing dollar swap lines with 5 large central banks, and they go to the jurisdictions where there are big overseas dollar funding markets. And in effect, those are overseas markets where, for example, a European or Asian institution is buying an asset-backed security that is backed by loans to American consumers. So in effect, these are loans to American consumers, and we support that. We want to make sure that dollars are available. They need dollar funding to hold those dollar assets. So the way it works is, when needed, we lend to the central bank in dollars, and they pay us back in dollars. They then
somebody go ahead and get tapped in.
They lend on in dollars.
If you don't know, we do it every day, every morning, sharing our pre-trading plans, calling out that 530 put, calling out that 529.4 entry. The 529.4 entry here, we had the beautiful break, then we had the retest, right back up to the 529.4. Beautiful. Called out that first profit target area of 524. That's not saying that we're not going to go lower. That's saying it's going to be a great area to get out, to put some money in your pockets. Second profit target area called out is 521. A little less than 2 hours on the market today. Jay Dilla said he took his profits. Had a better day today than yesterday. Now he's off to smoke a victory cigar with his pops, and that's what this is all about. Shout out to you, Jay Trey Dilla, for a monumental win today.
In terms of if I can say from my time working on these issues, it's not the Fed's issue.
And every day I share exactly what my trading plans are, and I am the first to say I don't know anything, but I do have the ability to read what the market is showing us, and I mark my charts up accordingly to make it very easy to follow. The 529 break is highlighted, very easy here to follow. The 529.4 area is highlighted, very easy to follow. The 524 is here in white, very easy here to follow. This morning, the beautiful put off of the 535 break, where we had a beautiful shooting star. Resistance line was right here at the shooting star. Very easy to follow. If you wanted to go with not just confirmation, but continuation, well, you had that at the 534. Very clear. Very easy to follow.
Let's turn to stability.
Please go ahead, hit that subscribe button as we are on our way to 1,000 subscribers. And what we do here is absolutely free. We don't charge anyone anything. The only thing we ask is that you come with good vibes The only thing that we ask is that you do positive things to help your fellow teammate trader achieve their goals and dreams. Explain something if they have a question. Show something if you see something. Call out something if you see something. We have all paid enough to these fake gurus who really don't know how to trade. On this channel, you have real trading with real traders, some real change. The support that we ask for the channel is by way of subscribing. Once I'm monetized, I will get my money from YouTube. Exactly. I do not have a problem saying that I will get compensated from YouTube. I'm not looking to make any money off any traders because we get our money daily here in the market. But to show support,
most of it has been funded
because we do know that when you pay attention. We do ask that you do hit the subscribe button, and we do ask that you do tell someone who is serious about trading. We lay it all out here, even all the way down to the playbook, which is also free. Calling out the actual trades, the setups I see, calling out my plans every morning. And I've changed the name from trading plans to trading rules. One of them will work. One of them will absolutely be wrong. It's just how it is. But everyone is welcome. You may hear my voice, but this is a team setting and a team effort. Well, that's all I have for today. The market will never stop yielding opportunities to make and take profit. As long as we're able to stick with our rules, identify who is in trouble, identify where they will be in trouble, and identify why they will be in trouble, we will forever be able to show up at the market and take advantage. As no one told us or showed us that this 526 was an intraday area of demand. The market showed us this. The market said, hey, this is going to be an area where a conversation is going to be had. Take profits at this area. Hold on for that 524. Once that 524 has been achieved, know that even on the way back up, there's possibly going to be a conversation here. Knowing when to trade, knowing when not to trade, knowing the areas to stay safe in is equally as important as knowing the areas to attack.
From what would be a good, I think, outcome.
We do this every morning beginning at 9:25. With live commentary all the way until 11. And then we leave at 11 and come back at 1. Every trade is shared. Every trade is transparent. We call out every trade, beginning by showing our plans by 9:25, 9:35 in the morning. This is Abdul Shabazz for some real change. Thank you for subscribing. Thank you for hitting the like button.
By the way, we worked with Congress to try to get a
feel free to make any comment that you would like in the comment section. Know it will be read and responded to. We will not leave you hanging.
Of that whole sector. So
thank you so much.
Congress is again looking at both the Senate and the House.
I hope you have enjoyed today's show.
Depending on what's
in the words of Tyrese Gibson, what more do you want from me?
That could actually have fairly wide
I'm out of here.
And should
God bless you. Be well.
Consumer protections of the typical sorts and transparency, and that's what the Senate and the House are working on. So that's a positive thing. I also think some of the we took a pretty conservative, and other bank regulators took an even more conservative perspective on the guidance and rules we imposed on banks. I think there'll be some loosening of that, and I think we'll try to do it in a way that preserves safety and soundness, but that, you know, permits and fosters appropriate innovation, but that does so in a way that, again, doesn't put consumers at risk in ways they don't understand or make banks less safe and sound.
You have a policy review underway. Now, surveys recently tell us there seems to be a distinction between a rise in the level of prices, which is what the public seems to worry a lot about, and the rate of increase in prices, which certainly they worry about in passing, but the Fed worries much more about. That is the rate of inflation. So even though we're coming down to 2%, people remember that over the last few years, it's been over 20% increase in prices. So as you start thinking about the policy review, is there any thought about how you might want to address this sort of challenge that it's the path of prices as much as the rate of change which matters?
I think you're right, and I think the public is right. When we say inflation is back down to 2%, 2.5%, and we think that's a good thing, it is a good thing. But if you're paying 20, you were paying in 2021, that doesn't help you much. You're still paying a lot more than you used to be paying for the necessities of life. So it's just another way of saying people hate inflation, and it's easy to understand why. All we can really control is a world in which, in the world we were living in, prices don't go down in the aggregate except in extreme times that we don't want to court. So I don't think we couldn't have a framework where we're going to bring prices down by 10% or something. That's not something we'll be looking at. We're essentially looking at changes we made in 2020 were really innovations around what to do when you're stuck near zero. Now we're well above zero, and it may be that we still need to have in our framework a way to deal with that, but perhaps the main case is not one where you're dealing with the effective lower bound, and that would be a framework that looks a lot more like the one that we had before 2020.
Now, one of the tools you brought in to deal with the zero lower bound was quantitative easing. But you've also used quantitative easing to fix disruptions in the financial markets. Are you going to be more specific about what your objective is with quantitative easing as you go through this review?
So in the beginning, it's typically, we're using it for financial market function. That was the case with the and with the pandemic, and we did try to explain ourselves through the pandemic, and our explanations did change. But I think it's fair to say we might have done a better job of being clear about why we were doing, and that's something that we're aware of and looking at.
I mean, no discussion is complete without talking about AI.
Yeah.
With AI coming fast and furious, it could affect productivity, it could affect employment. There are some people who say we will see for the first time technological unemployment in a serious way with AI. What are your thoughts about it, and how will it impact the Fed going forward?
So like everyone who's been exposed to what it's capable of, it's beyond, I mean, I started thinking about it as like a better version of Google, but it's not. It's like a better version of a person, I mean, it can do amazing things, and so the question is, all through the 250 years of technological innovation, technology evolves and people worry that it's going to replace human labor and people will be unemployed, and that hasn't been the case. It may be the case in the short run, but in the long run, what it's done is raise human productivity and therefore living standards. So is this going to be the case where it eliminates more jobs than it creates? And we just don't know. I mean, you come back in 20 years, will it be the case that just people are much more productive in their work because of AI? Or will it be the case that AI has just replaced a lot of people? And I think it's very hard to say, but it truly is remarkable in what it's capable of. And it's a demonstration by a Wharton professor recently, and you speak to it like it's a person, and it kind of responds like a person. And the things that it can do are really amazing. By the way, this is early days. You know, they're talking about even the next couple of years will bring more dramatic breakthroughs. So I think it's one of the 2 or 3 things most likely to bring dramatic change to the economy all around the world in the next 20 years. And I'd say very hard to say how it shakes out.
Let me turn to your job. An important man once said of your job, it's the greatest job in government. You show up to office once a month and you say, let's see, flip a coin. And then everybody talks about you like you're a god. What is it that you normally do every day in the office? Is it fulfilling and, dare I say, enjoyable? And do you really feel like a god?
So I would agree. I think it's the best job in government. I would agree. I really do enjoy it. Yes, I love the job. It's a great honor to serve. It's quite humbling because, you know, everybody makes mistakes. It's just the economy is just not very predictable. All of that is true. And I do what everybody expects me to do. I read. We do a little more reading though as part of our daily regime than a typical executive would do. In terms of being a god, I would say that we are blessed with a large number of amply compensated critics who would kind of tend to undercut that. So we don't feel like a god.
So let me go to the more mundane. In that office, what are the key indicators you look for? What are the sources of data that you go to as you try and make up your mind?
So, you know, I'd say start with labor. You know, there's more labor market data and better reliable labor market data than probably anywhere else. And it's just a lot of data. And, you know, it's new jobs, it's payroll, it's wages, it's participation. You can break all of those down in different categories. It's a million different things. So there's a lot of labor market data. It's a great field if you're going into economics because there's just so much to do. So and then we look at the inflation data. Also, I keep track of global developments pretty carefully, and I talk to my global counterparts pretty regularly just to stay aware of what's going on. Financial markets are really important, and you know and lately something that we're paying close attention to, as you would expect, what's going on around the world in currency markets, in fixed income markets, in equity markets, all of that. For me, though, my background was more in the private sector and you know, as an investor, and for a significant part of my career. And I have to talk to outsiders about what they're seeing and what they're dealing with for it to really kind of fit together for me. I can look at only so much data, and but to really get the story and the narrative, it's more talking to outsiders, and anecdotal data does help things kind of fit together for me, I would say.
Yeah, you told us about speaking with business people last night and getting a sense of what was going on in the Midwest. Let me turn to Fed independence. You've reiterated that you intend to stay in office until the end of your term, and that certainly reassured many in financial markets. What are the levers the government or the legislature have to pressure the Fed? And should one worry about threats to the Fed's independence once you're gone?
So our independence is a matter of law. Congress has, in our statute, we're not removable except for cause. We serve very long terms, seemingly endless terms. So we're protected in the law. So, Congress could change that law, but I don't think there's any danger of that. Fed independence has pretty broad support across both political parties and in both sides of the hill. So I think that's not a problem. There's a Supreme Court case people will have read, probably in today's journal, at which the Supreme Court may decide whether independent agencies generally, whether their authorizing laws can contain a provision that prevents the president from firing members of a commission other than for cause. And that's a case that people are talking about a lot. I don't think that decision will apply to the Fed, but I don't know. It's a situation that we're monitoring carefully. Generally speaking, Fed independence is very widely understood and supported in Washington, in Congress, where it really matters. And the point is, we can make our decisions, and we will only make our decisions based on our best thinking, based on our best analysis of the data about what is the way to achieve our dual mandate goals as we can to best serve the American people. That's the only thing we're ever going to do. We're never going to be influenced by any political pressure. People can say whatever they want. That's fine. That's not a problem. But we will do what we do strictly without consideration of political or any other extraneous factors.
Well, I have time for one more question. I know the question that's on all your minds. What are you going to do on interest rates next? But I'm not sure that you know, and I'm not sure you would tell even if you knew. So I'm not going to ask that question. The question I want to ask is a more personal one. What is it that you'd like to do most at home after an exhausting day flipping coins in the office?
I play one of my guitars. I do Zoom calls with my kids and my grandkids, and I go to the gym a lot too, just to stay in shape.
We need you healthy. We need you healthy. Thank you very much, Chair Powell.
Thank you.
And please join me.
That was Federal Reserve Chairman Jerome Powell speaking at the Economic Club of Chicago. A few big headlines that caught our collective ears were that Trump's policies are still so new, it is really hard to gauge the real impact. But the Fed does believe the tariffs are likely to generate at least a temporary rise in inflation, meaning prices may go up even from here. Powell also added that the federal government, though debt is on an unsustainable path, he likes to go to the gym. Welcome to Power Lunch, everybody. I am Brian Sullivan. Kelly, of course, on Squawk Box all week. She'll be back on Monday. One thing that is not going up, along with apparently prices, are stocks. The markets are down and down big across the board. The NASDAQ composite is down 3.5%. The NASDAQ 100 down even more. Small caps down about 1.5%. NVIDIA is a big drag on not only big tech, but the entire market, all because of a multi-billion-dollar accounting shock. We're going to get more on that in just a moment. But right now, let us get some reaction to everything that we just heard and some prepared remarks. And then, of course, that interview session on stage. Steve Leishman, senior economics correspondent, and Aditya Bave is head of U.S. economics at Bank of America Securities. They're joining us as well. I believe Steve is there. Steve, the comments about debt caught my ear. The comments about tariffs and inflation caught my ear, but you're the expert. What caught yours?
I don't disagree with any of the things that caught your ear, of course, Brian, but I think the operative thing that the market took away from this is Powell is in no hurry to cut interest rates because of the concern of what you read earlier, which is the potential persistence of inflation on the backside of a one-time increase from tariffs. And I think that was really the key. He really repeated remarks he'd made back in April, which were pretty strong back then. And now, after all of this tumult and uncertainty, he remains where he was. He did not second some comments that were made by a Fed governor that looked at the possibility of easing in either scenario of weak economic growth or strong economic growth or temporary or persistent inflation. I don't know if we have a piece of sound that I wanted to use that really did catch my ear. Just tell me, folks in the back, if you have it. If not, I can tell you what he said. And what it was that he's concerned that, hang on, let me just find this one piece of sound here, Brian, where he says he's worried about supply chains are likely to be disrupted significantly, and you would worry that that process will take some years. And if the inflationary process might be extended, he was comparing that to the pandemic. And so when you start to make those comparisons, you start to hear a Fed chair who's maybe a little more worried about the persistence of inflation and less reliant upon the theory that these are one-time pass-throughs.
Hey, Steve, I'll go back to you because these are critical elements for the Fed. Now, I've been pretty vocal. I don't know what the Fed can do here. Maybe you do. It could be a trade war. So what power they have over this and the economy, I'm not so sure. Maybe you have more insight into that. But let's be clear. If Jerome Powell is on stage talking about inflation, not disinflation or deflation, inflation, that is, I think, Fed speak pretty loudly for we are not cutting interest rates anytime soon.
I think that's the correct analysis. Now, it doesn't mean they won't when they can be sure. Now, there's two scenarios under which they might. One is that you have an outsized or very obvious downturn in the unemployment rate that really it makes it clear that we're going to have a recession. The Fed might step in that case. Or if we see only modest and very limited and contained impacts from the tariffs. But the trouble is, Brian, I keep running scenarios through my head. And I'm just going to look here because I just ran the numbers on the Fed probabilities. And what I came up with is the market thinks the Fed's going to cut in June. But it's a 69% probability or 70% probability. But you think about where we are in June. We have this 90-day period of negotiations that takes us through July. And let's not forget, Brian, if all we were talking about were a 10% across the board increase in tariffs, it would be the lead story and we'd be talking about that all over the place. But now we've also got all these other individual sector tariffs. There is a major change going on. I think the Fed chair said it was bigger than Smoot-Hawley, which I actually didn't know, but I'll take his word on that. And so the effects are going to be bigger. And so they're trying to figure this out. I keep thinking maybe, Brian, of Muhammad Ali doing rope-a-dope, which is really the way that the Fed is probably doing monetary policy right now, which is just covering itself up, taking the punches, and then at some point it lowers its arms and says, okay, now I'm ready to fight.
Well, everybody thought Ali was losing that for a long time until he came back.
But he
Aditya Bave, are tariffs inflationary or disinflationary or deflationary ultimately? Do you know?
I 100% agree with Steve. It really depends on the size of the uncertainty shock, right? So tariffs are stagflationary, but there's also, it's not just what they said, right? It's how they said it. And the manner in which trade policy has been released has been, a little bit disruptive for businesses, right? So there's a lot of uncertainty right now, and there is a state of the world where that uncertainty shock actually outweighs the stagflationary impact of tariffs, and in that case, tariffs will be disinflationary. But what we heard from Powell right now was hawkish. There's no doubt about that. Steve talked about the analogies to 2021, 22. Here's another one. Powell said, and this for me was the most important part of his prepared remarks, he said that you cannot have an extended period of full employment without price stability. If you're a Fed nerd like me, you remember that he was saying the same thing to justify the previous hiking cycle, right? Remember, they were hiking through what was in real time a technical recession. But the Fed stayed the course and focused on price stability, and we think they're stuck. We think they're going to do the same thing, at least in the near term, this time around.
So, Aditya, and I have been very vocally critical of the Federal Reserve at the ends of COVID or the middle of COVID because I thought they kept stimulating, they contributed to inflation by keeping rates too low for too long, and they stimulated, in my opinion, nobody cares, except Powell's talking about COVID-related or COVID-similar impacts from tariffs, meaning supply chain disruptions. Will the Fed and Jay Powell act the same as they did during COVID, if that's the case, i.e. stimulating, or do you think they've changed their behavior / learned from COVID, and some might say mistakes, who knows, and are going to act differently this time?
I think it's more the latter. So if you think about the supply chain disruptions, that was not during the period when the Fed was stimulating. That was when the Fed reacted very aggressively, perhaps a little bit late, maybe a quarter too late, but they reacted very aggressively. They raised rates by 425 basis points in 1 year. Now, I don't think they're going to do that again. but the case to stay on hold right now is pretty strong.
So, Steve, what do you think? You know Jerome Powell personally. What do you think he's going to do?
Well, I want to make one point off of what Aditya said, which is that notice that the Fed chair is not talking about rate hikes here. Some of his colleagues on the Federal Market Committee have kind of hinted at that. Powell really wants to stay put. He wants to use what he believes to be existing modestly restrictive policy in order to address whatever is coming from inflation. And by the way, a little bit of Fed speak in order to do that. Talking tough now perhaps creates the possibility that the Fed won't have to hike later by making clear to markets, to companies, to consumers that the Fed will not tolerate higher inflation. But I agree with what he said about the importance of elevating inflation to the importance, to relative importance to employment, the way he did back when he was hiking rates strongly. So I think the outlook here is the Fed just has to wait and watch and take a look at how things pan out. It is interesting that the tariffs have created a very unusual situation for the Federal Reserve. Normally, Brian, we would look for the dollar to appreciate in a sense of a country erecting trade barriers, especially the reserve currency that would limit the supply of dollars abroad. That's why the dollar would appreciate. But the dollar has actually gone the other way, and it has depreciated relative to most major currencies. That actually creates a secondary inflationary source, maybe not a big one, but it's something worth watching. That if we were a third world country, Brian, just real quickly, and we were facing this kind of depreciating currency, the central bank might be forced in that instance to be raising interest rates. We're not either, but I'm just saying that's the situation.
Yeah. And I guess, Aditya, my confusion, or maybe the question is this. It's like auto insurance rates. Auto insurance rates for the majority of Americans have soared. It's for a lot of reasons. Cars are more expensive, more technology, more wrecks. People are driving like idiots since COVID, whatever you want to say. I don't know what the Federal Reserve can do about auto insurance rates. And I bring that up because if tariffs are going to be inflationary de facto, what can the Federal Reserve possibly do against companies having to raise prices by a couple of percent because their costs have gone up? I just don't, unless they crash the economy so that people aren't buying anything.
Right, so what the Fed can do is not add more stimulus into the economy. Right, that's the best they can do right now. I don't think they necessarily want to tighten and exacerbate the downside risk to the labor market. I don't think they necessarily want to ease and exacerbate the upside risks to inflation, right? So it's a matter of, the analogy we've been using is stagflation is like your two kids running off in opposite directions. And you kind of have to figure out whether you just call them back, whether you chase one and then you get further away from the other. It's a very, very difficult decision.
Yeah, so Steve, I mean, that is the needle, I guess, that has to be threaded, is that if there are supply chain disruptions that are de facto inflationary in the near term, but possibly lead to an economic slowdown in the longer term because people don't want to pay higher prices on what already are higher prices over the last 5 years because of previous supply chain disruptions, what do Jay Powell and the other voting members of the Federal Reserve ultimately do? And more also, what is the bond market telling us? Because the bond market went really strongly one way and then about a week ago did a complete U-turn.
Yeah, and now it's actually a little bit weaker right now. I mean, it's kind of funny when you talked about Aditya talked about the two kids running the other way. I was like, well, put a leash on them or put them in a playpen or something like that, which is what the Fed wants to do with both dual mandates, I think. I think what the Fed does is it stands pat here. I was really interested, Brian, in your analogy about motor vehicle insurance, because that's a really good example. Remember what happened. The price of autos went up, and it was vehicle insurance that came later. And that's the kind of knock-on effect that you got to be worried about as a central banker. Oh, okay, we can see how much cars went up. Oh, but there's this other thing that comes down and pushes up inflation down the road. I think the best possible situation here is for the president to come out very, very strongly and definitively about what these tariffs are going to be so we can get on with the process of figuring out the future of the economy, the market, and monetary policy.
Steve and Aditya, I've got some very good news for you and all the viewers and very bad news for me. We're about to begin a massive home improvement project, home construction project. And so I'm going to be living these tariffs real time, firsthand, first person for like the next 9 months. So anything I see, I will tell Steve, and then he can tell the world, and it's going to be great. And I'll probably need an adult beverage or 3. Aditya and Steve, thank you very much. Do appreciate that. All right, speaking of the bond market, why don't we get bond market reaction to some of those comments? And also, Rick Santelli, talk about this U-turn that we just talked about, because bond yields crashed and then soared all like the last 8 to 10 days.
Yeah, there's been a lot of movement, but I'll tell you, there is something to be learned today. And before we get to any charts, don't show the chart yet, control room. Remember, the short maturities are most associated with thoughts about the Fed, what investors are thinking about the Fed. And the longer maturities historically are more in tune with things like inflation and the economy and its output and its condition. Having said that, let's look at the S&P and a 2-year chart paired together. And what you don't notice is there really wasn't a lot of movement to the downside in the short maturities. But when you pair up the S&P and a 10-year, there was a much better correlation that as stocks moved down, they dragged 10-year yields down with them. So my interpretation of that is rather important, at least in my mind, and that is that we were concentrating more, investors were concentrating more on Powell's influences with regard to his speaking about a weaker economy, potentially a weaker labor market, potentially weaker consumer spending versus anything for the Fed riding to the rescue. And to back that up, let's look at these Fed fund futures. There really wasn't a lot of movement, and any movement there was really towards the end. Pretty much when he was done, it moved back up, because there's always hope that if the equity markets may get nasty enough, maybe the Fed would ride to the rescue. And as Steve has pointed out, we still see potentially an ease in June. But all things being equal, the differentiation between short and long maturities when Powell was speaking, I think, is very enlightening.
We got to go very quickly.
Everything right now is about inflation and the strength of the economy.
But, fair enough. Very quickly. We got to go. Is there anything the Fed can do? Do they have the power to do anything?
Well, my opinion is, if you're asking, will lowering rates help things like auto insurance? Of course not. But then again, use that in a variety of situations. Lowering rates doesn't really alter many things that are going to be pushing inflation up or the economy down. Ultimately, I think that what the Fed is going to try to do is just make sure the markets have enough liquidity to continue to function.
Well said. Rick Santelli, as always, thank you very much. All right, folks, so we got a market alert. The NASDAQ 100 is down 3.5%. It's one of the biggest declines that we have seen this year. NVIDIA shares, they are sinking. They are the worst single performer on the S&P 500 today. It all has to do with a big accounting hit that they kind of shocked the market with after hours yesterday. Christina Partsinevelos up after the break to tell you what NVIDIA did that is spooking the market so much. We're back right after this.
starts now.
All right, welcome back. It is a rough day for arguably the most important stock in the world. That is NVIDIA. NVIDIA shares down almost 10% right now. The company surprising the market with a more than $5 billion accounting hit related to trade. Let's try to make sense of all of this. Christina Partsenevelos joining us. Now, I understand there's like export controls and fancy words, but the reality is the market did not see this coming.
To a certain degree, the restrictions were actually expected. We just didn't know it was going to be $5.5 billion write-off. But their news actually gets worse, Brian. And I say that because now the House Select Committee on the Chinese Communist Party has launched its first ever investigation into the chipmaker to determine if it knowingly provided critical AI technology to Chinese firms in violation of export controls. This according to the New York Times. And this development actually broke, Brian, in the past hour. And I can confirm that NVIDIA had previously appeared before Congress to answer questions on this matter. So this is additional scrutiny, and that's why you saw the stock drop even further to 10%. NVIDIA was already trading lower after we talked about announcing that $5.5 billion Q1 charge following new U.S. government export restrictions on advanced chips to China, including the H20s. So this means that all the upcoming NVIDIA Blackwell products are also unlikely to meet compliance thresholds for Chinese markets. NVIDIA will have to seek out licenses. Evercore ISI reports conversations with NVIDIA's CFO revealed limited market expectations for these chips outside of China, and H20 production can't be easily shifted to Blackwell because of different manufacturing lines and processes, which is why you're seeing such a large write-off. While China, though, does contribute about 13% of total fiscal 2025 revenue, it's the lowest level in a decade. So Wall Street right now, a lot of the sell side are cutting estimates. Morgan Stanley right now indicates these license requirements will reduce data center revenue by 8 to 9% over the next few quarters. So definitely a hit to revenue. Meanwhile, Trump's new export controls really could significantly boost sales for Chinese domestic manufacturers led by Huawei, which has been aggressively developing its own AI processor. So a lot of news for NVIDIA today, Brian.
Yeah, there really is. And it's something that the market clearly is surprised, Christina, because NVIDIA stock is down 9.8%.
That's also because a week and a half ago, there was a report that Jensen Huang successfully convinced President Trump to not ban these chips. And so now we know that that's not true. And it seems like the administration is not going to back down. So who else will be next? AMD said that they're taking an $800 million charge. Broadcom could be next, given their relationship with ByteDance. We could see Marvell in the mix, et cetera. So it's really weighing on the entire sector.
It really is. And that sector is arguably one of the most, if not the most important in the market. NVIDIA's in about 500 different ETFs, so that news bringing down semis, which is bringing down the market. So between NVIDIA and the Federal Reserve Chairman, you got plenty of news today, but investing is not a one-day game. So what is the longer take on protecting and growing your money? It's a scary time. Joining us now is Jim Tierney. He is CIO of U.S. Concentrated Growth at AB, and Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. And love having you both on, Kathy, because I'm trying to make the point. Today's a big move. Last week we had big moves, and the week before that we had even bigger moves. Most people that are watching and your clients are thinking about 3, 5, 10, 20 years from now. What moves, if any, should they be making right now?
Well, hi, Brian. I think the most important principles right now are the basic principles for an individual investor, and that is to stay diversified, to understand your own risk tolerance and your risk capacity, and to try to ignore the noise. So in fixed income, we typically will suggest a long-term investor who's looking for fixed income to provide income and capital preservation and diversification from stocks, stick with higher credit quality bonds for the bulk of their portfolio, and probably right now have about an intermediate term duration, 5 to 7 years, somewhere in there. That's a sweet spot. You can earn a fair amount of interest income without a lot of credit risk, without a lot of volatility and interest rate risk. And I think this is a great environment for that because there's so much up in the air, so much uncertainty, so much volatility. We're just sticking with a real basic kind of up in credit quality, intermediate term duration portfolio.
Yeah, and Jim, I kind of made a tongue-in-cheek comment the other day. I'm not sure I'm doing this 29 years, when there was a great period of certainty. We always talk about there's so much uncertainty. Life is uncertain. So is there any certainty in investing right now?
There is not. We're going to learn a lot more in the next few weeks in terms of how companies are dealing with tariffs and what the tariffs are really going to be. There are a bunch of negotiations going on, so we'll get a little bit more certainty. But I think as an equity investor, which equities make the bulk of most people's portfolios, you have to find the opportunities. You have to be selective. And I do think there are opportunities out there right now.
Yeah, and Jim, we go back and we say, okay, is now the time to sell because the markets went up 10% off the lows. We're down 20%. We spiked back 10%. People obviously were selling into that gain up. It's not my opinion. The market is down. But again, if I'm investing for 3, 5, 10 years from now, I want, I think, slightly lower prices now in a market that is still up 90% in 5 years. We're coming off back-to-back 20% gains. I want to go up 20% every year. It's just not possible.
No, I don't think it's possible, but it is possible to find companies that can grow double digits over the next 5 years. And if you do that and attach your clients to those kind of companies, I think you do well. Right now, with all the tariff uncertainty, you don't want to be a major importer or exporter. But if you have manufacturing around the world and you're building local for local, I think that's a phenomenal opportunity.
Yeah.
Companies like Eaton do that. Companies like Amphenol do that. Eaton is in 35 countries around the world. Amphenol is in 40 countries around the world. I think those companies are going to be much better protected. And then companies with pricing power. If the tariffs come to be in effect in some form or another, if you have pricing power, you're going to be more protected than companies that don't. Ecolab announced this morning that they are implementing 5% price increases across the board. If they can achieve those price increases, they're going to be a heck of a lot better off than a company that's going to have to eat it. And that's what we're looking for.
Yeah, the Eatons, the Amphenols of the world, these are interesting names. Kathy, going back, because our top story, obviously, we're at the beginning, was Jay Powell. And Jerome Powell was, did the sort of the fireside chat, whatever you want to call it, at the Chicago Economic Club. Is there anything that you heard that makes you think that there's a change coming in the direction of the Fed and or interest rates?
No, in fact, I think if there was any surprise, it was that he defended their position of sitting on the sidelines and waiting. There might have been some hope out there that he would indicate, yeah, we're getting ready to cut rates because, we're confident about inflation. But instead, he basically said, no, we're going to wait and see, get some clarity. We're pretty confident we're in the right place right now, and we'll let you know later. I was surprised he talked about inflation expectations being well anchored. I think there's some evidence that they're not as well anchored today as they were 6 months ago or a year ago. So I'm a little surprised that he alluded to that.
What is that? What do you mean by that, Kathy?
Well, when I look at some of the survey-based data, and put aside University of Michigan because that's got some issues around it, but in general, what you're seeing is from the New York Fed, from various Fed research groups, that inflation expectations have moved up over the last 6 months or so, certainly the last couple of months. So they're edging more towards 3.5%. They're moving in the wrong direction. And it's not, it's not extreme yet, as it might be for some of the Michigan survey data, but it's still moving up. And those break-even rates in the TIPS market, moving up. So I'm surprised to hear him say with great confidence that inflation expectations are well anchored.
Yeah, I'm not sure there's much I could say right now with great confidence about anything. Kathy Jones and Jim Tierney, except that you're both great guests. Really appreciate it. Thank you. And both wearing pink to maybe celebrate the warm weather. All right, up next, your blueprint for navigating Trump 2.0.
go with TimberTech.
Attention car buyers. Here's a story that we actually were kind of just talking about with tariffs and price increases. Automotive News is reporting Ford is telling its dealers that it may, and it may not, but it may raise prices next month if tariffs continue. We got that headline. We reached out to a Ford dealer, an actual Ford dealer, and he did confirm that this indeed is being discussed. We don't know if prices will go up. Ford may not know if prices will go up, but there was a notice that Automotive News reported that we confirmed with the dealer moments ago that prices may indeed go up. By the way, will automobiles or Ford or furniture or carpet or whatever, will all that stuff go up? We don't know. All right, let's help you plan for what might happen out of Washington, having to do with exactly that, because trying to get it exactly right is probably exactly impossible. But we do have some of the smartest minds out there try to figure it out. Joining us now is one of them, Morgan Stanley Global Head of Fixed Income Research and Public Policy Strategy, Michael Zezas. Michael, again, thank you to you and your team. I've gotten smarter because I'm reading you and your team's work, and it really matters at a time like this. You just heard the Ford news, and again, it's sort of news-ish because we don't know if those are going to happen. I hate the term uncertainty, but I got to imagine that this now is the definition of uncertainty.
Yeah, I think it's totally fair. I think you're exactly right that there are so many plausible ways that these different policy paths, and particularly the tariff path, can play out that investors in general just have to consider multiple possibilities. Now, I think as it pertains to tariffs, I think there's good reason to have some optimism that the level of tariffs that were being talked about a couple of weeks ago ultimately won't be implemented to that degree, because it looks like there's pretty good case for successful negotiation with Japan and maybe even with Europe a little bit further down the line, maybe less so with China. But it all sort of nets out to a higher tariff base than you had before, right? So even if things directionally get better than they looked a couple of weeks ago, the way our economists are mixing it all together is to say we're still looking at a slower growth dynamic for 2025, somewhat higher inflation, and all else equal, higher probabilities of recession. So direction of travel might feel better, but the net effect is still a murkier outlook than we had just a few weeks ago.
No, but your point is really critical. I'm not trying to be a Pollyanna about this. The tariffs may go as they are now. You just said they may not. They may not be the numbers we think. And also, there's a big legal challenge that's going on. And another firm, one of your competitors, putting out a note today saying that the courts may ultimately deem the tariffs are illegal or invalid. There are other things out there which I think you would agree that leave a market risk to the upside.
Yeah, well, so let's talk about some of the circuit breakers, right? So one of them, to your point, is legal challenge. This is an important point because the reciprocal tariffs are kind of premised on this law called IEEPA. And I'm not a lawyer, but a lot of legal scholars think that's sort of a flimsy premise for them. If a court were to put an injunction on these tariffs coming into play, that doesn't necessarily mean that they couldn't come into play eventually. There are probably studies that could be done, Section 301, 232 studies, to kind of stitch back together that authority over time. So I think all we'd be doing there is extending this uncertainty. So I do think we kind of have to live in a world where we expect that the average effective tariff rate that the U.S. is levying on rest of world is still considerably higher than it was in previous years. It just will end up being not nearly as high as what was announced back on April 2nd.
Yeah. Do we believe that the national debt or trade deficits are truly a national emergency? That may be ultimately a question for the courts. So let's take the other side, Michael. If we do get the worst case scenario, which is upwards of 200 whatever % tariffs on some China goods. Because remember, we already have 100% tariffs on Chinese electric cars put on by the former president, right? We're not starting from zero here. And if you know the numbers, please let us know. What's your worst case, base case?
Well, if we live in a world in which, no more exemptions are applied and you're sort of north of 100% on China tariffs and there's sort of no negotiation on the horizon, so they're there for an extended period, then, our economists have said that very clearly kind of tips you into recession. I think if you broadly look at markets right now, what our strategists are saying is that we've kind of priced into equities, into credit, kind of the first order effects of all of this, right? So the idea that the incremental costs that are likely to endure, we've kind of fed them through and tried to account for the pricing. But the kind of second order and nonlinear effects that could lead you into a recession, that's not really in the price yet. So one of the things that could touch that off would just be long duration of very high tariffs on China.
And we will, and again, a standing question right now. Markets taking a one-way. Michael Zezas of Morgan Stanley. Really appreciate your views, folks. We about ready to go to Scott Wapner, closing bell. Just a quick check. Markets down big. The Nasdaq Composite is down over about 3.5%, 4% now. Nvidia is down 10%. Market selling off into the close. We'll see you tomorrow. Scott picking it up right now.
Brian, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 right here at the New York Stock Exchange. This make or break hour begins with this late day sell-off in stocks and why it's the Fed chair who might be responsible for initiating it. We'll have more on that in just a moment. We're showing you here the majors with 60 to go in regulation. We're sharply lower across the board, already weaker today, thanks to a big decline in shares of Nvidia. On new China export restrictions, there's been some new news within the last hour, dragging those shares even lower. We'll have the very latest there, too. Most of tech is falling today. Big declines in several other chip names. Mega caps are lower across the board. Consumer discretionary stocks are very red, too, led by Tesla. Watching all of that, it does take us to our talk of the tape, which is all of the uncertainty caused by President Trump's trade war. The Fed among those in a big fog over where inflation and the economy are really heading. Chair Powell was in Chicago today talking about that. Our senior economics correspondent, Steve Leisman, joins me now with more. The market definitely sold off as the Fed chair was talking. What do you think specifically it was, Steve, that unsettled the market further?
I think it was focused on making clear that despite, Scott, heightened uncertainty and downside risk to the economy, he remains focused on avoiding any secondary or knock-on effects of tariffs on inflation, and he won't respond with policy until he can sort it out.
How long does it take for the tariffs to have their effects on inflation? To the extent it takes longer and longer, that raises the risks that the public will begin to experience higher inflation. They'll come to expect it, and companies will come to expect it. So that risks higher inflation.
Powell reiterated his hawkish remarks from April 4th that the Fed's obligation is to keep those one-time price increases from becoming an ongoing inflationary problem. And that would seem to dash any imminent hopes for a near-term or preemptive rate cut. Markets are priced for rate cuts in June, July, and October, and maybe even December, just barely. So, Scott, we're headed for an interesting, perhaps, conflict here, unless the market knows something about what the Fed's going to do that the Fed's not letting on that it's going to do. Best bet right now, I think, is the Fed stands pat until it's clear that tariff one-time inflation doesn't become tariff two-time or more widespread inflation, Scott.
I don't know if this was a deliberate pushback on Waller from a day or two ago, but it felt a little bit like that. And the other thing I think is important to note here, and I think the Fed chair alluded to this as much, is that the tariffs were so much higher than he and the Fed had anticipated that he's now talking about the effects of that causing inflation to be more persistent, potentially, than they otherwise would have thought. I don't hear the word transitory front and center anymore.
So two things. One is he's repeating that about the tariffs being larger than anticipated, even after the April 9th rollback. So I think that is important. And I also think you're right. It's important that he's talking about more concern. That's why I played that sound, that quote from him, because he's more concerned, it seems to me, about the potential persistence of inflation. On the Waller thing, he didn't push back. He did not push back. But from a strictly analytical point of view, Scott, he did not affirm the dovishness of Governor Waller. And I may think, Scott, That's why the market was most disappointed, because it did take a dovish signal from Waller, and that signal was not reaffirmed by Chair Powell today.
I tell you, the other thing that stuck out to me, Steve, was this notion of picturing a scenario in which the mandates could be in tension. That implies a degree of uncertainty about potentially what to do in that scenario. A labor market unraveling a bit more, while inflation potentially remains more persistent, puts them in a potentially bigger pickle. And I think that's what that alludes to, the tension of the mandates that they have.
Yeah, and it's interesting, Scott, when you look at those probabilities, the market very firmly believes that the tension will be resolved in favor of the unemployment mandate. The idea being that that we will have noticeable increases in the unemployment rate, and the Fed will see that, and the Fed will respond. I don't hear that necessarily from the Fed, because what the Fed is saying is this notion from its long-run statement of goals is that we're going to look at which one is furthest from our goal, how much time it would take each to get back, and we'll decide policy that way. It may be the market's right, but it's not 100%.
And I also I feel like there's been a distinct change in tone when the Fed chair talks about the economy too, which he's felt really good about. And he's made that case, whether it's at meeting or at speech, up until the so-called Liberation Day, where it's really thrown things so far out of whack. As I wrote at the top here, they find themselves, like everybody else, in a pretty thick fog.
Right, and look at what the Bank of Canada did today. They said we have two scenarios. Look at what UAL did. Two scenarios. Everybody is operating as if there are two equal possibilities, and it's very difficult to put a probability on either one. That's what markets do. You give possibilities, markets do probabilities, but it's very, very hard now to think that, I don't know, 50-50 we could have a recession, 50-50 the Fed could cut, 50-50 the Fed could, I don't know. I don't think hiking rates, but certainly stay where it's at right now. I also thought, by the way, something about the tone of Powell was interesting. He made comments about the negative impacts of firing scientists and some government workers. He also made comments about the idea that we are not necessarily going to get where we need to get on the debt by only attacking the discretionary part of it. Kind of a little bit of a minor broadside at Doge, saying you're not going to get there by just firing federal workers or cutting discretionary spending.
Yeah, I want you to stay with us. I'm going to bring in our panel, if I could. Lauren Goodwin of New York Life Investments, Chris Harvey of Wells Fargo Securities. Guys, I should also note the NASDAQ on your screen is down more than 4%, right, almost 700 points. We've become more accustomed of late to seeing outsized moves like this, which are so not normal. You're not supposed to get a 4% move intraday on the NASDAQ like we're seeing here. What did you take from Powell? And I think it's undeniable that the market is not feeling good about what it heard.
Yeah, I think that's right. And you really laid out what I think is a critical point, Scott, which is that the Fed's mandates are now moving in opposite directions, and the chair's admission of this and acknowledgement of this is so critical, because what it shows us is really a couple of things that I think the market is digesting. First, if everything's a 50-50, as Steve is describing, then news like this in either direction can whipsaw the market, upside and downside. I think second and critical is that even if the Fed were to step in with a rate cut, what good does that do to clear supply chain tensions? It does very, very little. And third, what the Fed does is becoming more and more divorced with what's happening in market interest rates. So with inflation expectations on edge, certainly near-term inflation expectations de-angered, if the Fed's cutting rates in that environment, then you might still see market rates move higher, like the 10-year yield move higher. That's so challenging for real purchasing decisions in the economy. And so investors are seeing this and saying, wow, if the Fed's stuck, we're stuck too.
Now, Chris Harvey, including the other day, you have been resilient in yourself of sticking with your idea that we could still have a really good return this year in the stock market. And I thought you articulated your views very well, whatever it was, three or so days ago that you were with us. Market doesn't like what it heard from the Fed.
No.
How does this all factor into the way you're thinking today?
So, Scott, what I think you need to do for the next, let's just call it 3 months, market's going to trade in 5-6% increments. It trades up and your portfolio's not doing so well, you need to take risk out. It trades down, your portfolio does well, then put a little bit more risk on.
We need to be that tactical? That's hard for people.
It is hard for people. So if you don't like it, then take the risk out on up days, wait until the second half of the year. I think you're going to have a lot more clarity in the second half of the year on tariffs, on the Fed, and the economy. And what I see is a Fed that's cutting rates next year. And the important thing is, if we go into a slowdown or recession, there's a difference between a recession that's caused by exogenous shock, which is what we're seeing, and one that's caused by balance sheets that are upside down and backwards, which we are not seeing.
What if it's caused by the hand of one person?
Well, that's the exogenous shock, right? The exogenous shock is we don't know. We don't exactly know what we're handicapping, the degree of tariffs, the timing of tariffs. So markets are rightfully so being a little bit skittish in pricing and risk. The other thing that you're seeing in the bond market is they're pricing in confidence and credibility issues, something we haven't seen in a long time. U.S. is still a very high quality entity, but now there are questions about how high quality and what premium we should put on that. And so when you wrap all these together, you're still going to get a lot of volatility. If you're an institution, you can't just walk away. What you want to do is protect your portfolio with some sort of low vol, but you also don't want to put your head in the sand. There are still some good risk rewards out there, and you want to slowly start taking advantage of some of these sell-offs because the secular AI trade is still one of the best secular trades out there.
How concerned, Steve, do you gather the Fed chair and group are about what we've witnessed in the bond market and with the dollar, for that matter? And I think he was asked specifically about the dollar, but you tell me what you think is, top of mind for him on those two topics.
I think that they're concerned. I don't think it's risen to the level that they feel they need to act. I believe the question was about whether or not there were dollar swap lines, unless I missed something he said specifically about that, Scott. I'll have to go back and check the transcript. The Cleveland Fed president, Beth Hammack, did mention it today that it was an odd risk-off set of trades that happened with the bond market selling off as well as the dollar selling off. I don't think the Fed is particularly concerned right now, though I would imagine they are in touch with their central bank counterparts around the world to do something if it's needed to be done. It's just, he did mention, Scott, I thought that it was important when he said these are bigger tariffs than Smoot-Hawley. And you remember what was going on back then. There was a global depression that happened back then. And so I think you should not understate the sense to which the Fed sees what's going on right now as absolutely historic for the U.S. economy and historic for global trade flows, as well as historic for currency relationships around the world that could ultimately involve them in some way.
Yeah, I mean, it's historic in so many different ways. The apparent willingness of the President of the United States to upset the economy and the market at the same time. What's also been upset, I think, as I was alluding to a little bit with the bond market and the dollar, are these classic safe haven moves. These hedges, if you will, that investors who watch our programs during the day wonder how they can take cover from this trade war storm, and there haven't been that many places to hide. You suggest the 60-40 portfolio was not designed for this, and it ain't going to work in this scenario. Tell me more.
Yeah, that's right. The 60-40 portfolio was designed for a time when inflation was lower and more specifically, inflation volatility was lower than what we're seeing now. And the moves that we're seeing in asset classes like treasuries, like the dollar, are related to that inflation volatility just as much as risk preference. And so as we're looking at where investors can seek shelter,
We're actually seeing the volatility of the markets right now as having some pretty clear investable through lines. Chris got to this at the end of what he was describing earlier, but alongside supply chain reglobalization and trade dynamics, there's a decade or more worth of trend in this direction. We don't think that's going anywhere. And so there are resilient equity names, quality that we think can be found, but we're looking more and more into how you can build income in a portfolio. So whether that's dividend paying equities, whether it's holding on to some of the asset classes like gold that don't provide income but do provide a bit of a ballast. And despite the volatility in fixed income, I completely agree with what Chris was describing, that we're not seeing a balance sheet issue, especially in the 2 to 3 year term for U.S. companies. And so the opportunity to take some equity-like risk in those, yes, still price volatile, but income-generating fixed income opportunities, we think can help investors navigate some of the volatility we're seeing.
How do you address that?
How do I address that? So one thing I just want to get clear is we're talking a lot about inflation. If you look in the bond market, break-evens or inflation expectations are actually coming down. Now, you can take that one of two ways. They're coming down because everyone thinks we're going through a recession, or they're coming down because people are looking through some of the short-term news. One of the things the Fed has always said is we expect longer-term inflation rates to come down to our 2% rate. Break-evens are coming down to their 2% rate.
I know, but like 1 year inflation expectations in the most recent reads, more than one, suggest otherwise.
But 2 year break-evens are also coming down. They're much higher, but they are coming down. So directionally, that's right. The other thing is a recent CPI. In addition to that, the conversation I'm having with people is just because prices go higher doesn't mean they're going to buy. Just because if a car price goes higher doesn't mean that people are going to step up and buy that, right? They'll change their basket, they'll substitute that basket, and they'll try and mitigate that. If that demand still is hot while prices are high, then we have a problem. But if people start to pull back and the U.S. consumer is pretty savvy, I do expect them to rearrange that basket. So we have to be really careful about the way we talk about inflation and what we're doing. Just getting back to your conversation about where you hide and what you do, you know, the 2 years is still a good place to be. Low volatility is still a good place to be to anchor. And if you're a longer-term investor, again, a lot of these AI trades, whether it's in utilities, industrial technology, are in a bear market. Right? And you can make money I believe you can make money longer term in it, and you want to start legging into it on days like today.
Steve, it wasn't but, 2-3 weeks ago where if you thought the Fed was going to become more engaged anytime soon, May was off the table. It was like, okay, well, forget, it's not going to happen in May, but if they do anything, it's going to be in June. Now I feel like we're just pulling things forward, that we've introduced the idea that, I don't know, May could end up being live in a way that we didn't think it would be if things continue to develop in the way that they might.
I don't think so, Scott. I think that that's what the market hopes, but that's not what the Fed is saying. The Fed is saying, I mean, you could make an argument. I'm not saying this 100% clear. You could make an argument the Fed is telling the market, you're even wrong about June. With that 70% probability about June, I personally have been saying for a very long time, I don't see how the Fed feels as if the inflation story is clear to the point where they could cut rates in June. So what you need to talk about, Scott, is, well, first of all, I don't think the Fed cuts because the stock market is down. What you would require in the month of May would be an unemployment rate that shoots up considerably and probably a negative print on the jobs numbers, which I suppose could happen, but I don't think the momentum in the job market, if that were to happen, you could maybe get May to being a live month. But I still think that if you're listening to what the Fed chair is saying, that we need to be clear we don't have secondary inflation, that the Fed is standing pat, maybe even through June. I keep saying this. The market keeps ignoring me. I guess it doesn't matter.
The unemployment rate right now, I mean, I've got so many numbers in my head. Where are we? 4.3? Is that where we are?
4.2.
4.2. Is there a number, like a line in the sand kind of a number, that if you approach it, the Fed starts to freak out to the point where they would be willing to move that way, even if it was, in the Fed chair's language, in tension with the other side of the mandate?
Scott, I got to look at the calendar because the meeting is on May 7th, and I'm not sure Okay, we're going to get the employment report on May 2nd, I believe. Okay. May 2nd is the employment report. May 7th is the meeting. If you had a 0.3, maybe a 0.3 increase in the unemployment rate, that might be a number that would catch the Fed's attention and say we should cut, or maybe signal rate cuts. But Scott, I don't get why it's hard for people to put them in the shoes of the Fed here, that you're going to be looking at what could be a 1 or a 2 percentage point bump up in the inflation rate. I just have a hard time thinking that the Fed is cutting into that. I mean, I've said this several times, that when the biography of Powell is written, it's going to read a lot more like Paul Volcker than it is Arthur Burns, which means I do not believe this Fed will countenance a rise in the inflation rate in monetary policy. I believe they will lean against it. So I can't say enough that I think the market is overly optimistic about an imminent or near term, even the next couple months, rate cut.
Wouldn't that be something, Lauren, if Powell, I hear Steve, and he knows more about this in his pinky than I do in my two hands together. So I get that. But if the Fed chair was forced to make the bet of all bets, if the labor market starts to deteriorate, but inflation ticks up a little bit, but he still convinces himself that it's going to be transitory, that it's only short term, whether they would make that bet and put it on paper through a rate cut.
The swing vote in that circumstance, if the Fed's mandates continue to move in the hard data in opposite directions, is going to be financial conditions. Because what financial conditions can help the Fed to assess is, look, the data right now, especially the data of the last couple months, Steve's right, it's not going to be rapidly deteriorating because real economic conditions haven't had time to really reflect any deterioration. We don't know that that's happening. And so what financial conditions will tell us is how is the market digesting the outlook for inflation, the outlook for employment. And if financial conditions are deteriorating to a point where you can't access liquidity, you can't, finance yourself as a company in this economy, then the Fed might be more interested in acting. But I'll say this, here in the next couple months, I agree with Steve, even if financial conditions are deteriorating in that way, it's really difficult for me to see the Fed using interest rates as the way to address that situation, because there's very little that a lower policy rate can do to stave off supply chain disruptions. Financial conditions, on the other hand, there are ways that they can step in, whether it's with liquidity. I think only in an emergency situation and temporarily would they use bond buying, but we might see those tools used first before the policy rate.
Well, I mean, they clearly believe that their toolbox is bigger than just one item in it. It's a large item, obviously, but I think they believe that they have other things at play. I alluded to the fact of your S&P target is still, I think it's the highest as it currently stands on the street. And you made your case as to why you think even if we don't get to that number and it's just a number, we can still have a good go of it. It's 7,007 is where you stand. Can we get there without the Fed?
We can get there without the Fed. So the way we get there without the Fed is we get agreement in North America, in large parts of Asia, in Europe on tariffs. Again, the economy was in a pretty good spot where we were before. Second half, one of the things that we've talked about is M&A activity and IPOs. We can see that start to bubble up. You start to provide more confidence, right? People will expect the Fed, if inflation, what's driving inflation is tariffs, then that fear should start to come down. Rates should start to come down, and that should start to push equities up. And what we're seeing in the first part of earnings season is underlying fundamentals are okay, and as you were talking about, there's just a ton of uncertainty that people are dealing with.
Well, what if we're learning in real time that both the Trump and Fed puts are much lower than we thought?
Yeah.
And that it's not the stock market that's going to initiate it. Like the only reason that people suggest they pivoted the way they did now, because the bond market was screaming at them to do something. But let's just say, for argument's sake, the bond market remains calm.
Yep.
Rates either remain where they are, they don't start, getting out of control like they look like they were doing. The rate of change was so dramatic in a handful period of time. But let's just say that the bond market remains calm, so that's not a forcing mechanism.
Right.
but that the equity market, we've learned, needs much more downside. Steve said the Fed wasn't going to react to a falling stock market. Maybe the president isn't either.
So let's just talk about the Fed one more time, okay? So it's in the Fed's best interest to do what they did. They should be hawkish. In the past, they've pivoted too early, right? As Draghi said, the power's in the promise, right? If they continue to be hawkish,
Isn't he the one who also said, we'll do whatever it takes?
He did say, we'll do whatever it takes. He said that.
Big promise.
You forgot about that one.
yeah. Always call me out. Thanks. I appreciate that. But what happened today? We had some bad news about NVIDIA. We had people thinking for some reason the Fed was going to be dovish. They turned out to be hawkish. Fed's doing its job, right? Its job is to bring down inflation. One of the ways you do that is through communication. They're communicating we're still going to be tough on inflation. And now the market's taking this and it's a little bit upset by that. That's fine, right? Because what we're seeing from the bond market is, hey, we're not as worried about that. What we're seeing from the market in general is, yes, we think the Fed is going to start to cut and ease three or four times, maybe four times the second half of the year. And that's good. So overall, I think we're in a decent spot, but if you can't stand the volatility, either start bringing the risk in a large degree because it's not going away, or just go to cash.
Steve, I got to let you go, but I'll give you the last word based on what you just heard briefly, please.
Well, I think it's interesting to talk about the stock market here when JP Morgan last week sent a spreadsheet out to its clients saying, if you want to figure out what's going on with one of your companies that you own and tariffs, here's a spreadsheet. Because they can't do it, nobody can do it. The lack of visibility on earnings to me is remarkable. The lack of visibility on the economy is something that I don't know that anybody's ever seen here. I don't know that you can, and I've heard this from other investors. I obviously don't do the stock market very well, but they've said you can't short this market because of the tweet risk from the president, and you can't go long because of the policies he's put in place. So I don't know what that means if everybody is standing
Fetal
still.
position.
Maybe your bid-ask spreads widen because there really isn't a market out there. My checks on the financial plumbing, so to speak. I had a nice chat with a gentleman about the asset-backed security market. These things are still clearing. They're wider. High yield was wider. And I just point out this NVIDIA thing is completely self-induced. This is a direct line from the president's tariffs to one of America's great companies saying its earnings will be down and bringing down the stock market with it. And I think the knock-on effect of that, Scott, is important, that the president sees this almost every day happening and he doesn't change his policy. And so I think that is another negative on top of the initial negative of the policy itself.
I think we were alluding to that too. Steve, thank you very much. That's Steve Leisman, our senior economics correspondent. You guys are not off the hook yet. I need you to stay with me. I want to go to Christina Partsinevelos now because she's been following NVIDIA all day. We already knew that it was a bad day that was shaping up here because of these export restrictions to China. Shares were already down all day. And then there was a new report within the last hour or so that led to another leg lower. What was it?
Yeah, it was a new report about congressional investigation. The House Select Committee on the Chinese Communist Party has launched its first ever investigation into the chip maker NVIDIA to determine if it knowingly provided critical AI technology to Chinese firms in violation of export controls. This is according to the New York Times you're seeing on your screen, but I can also confirm NVIDIA has been questioned by Congress on this matter, but this right now is additional scrutiny, and that's why you saw the stock, you're seeing it hit session lows right now, down 10%. NVIDIA responding within 5 minutes ago, just on my phone, saying that from a spokesperson, they follow the government's direction to the letter, quote, if the government felt otherwise, it would instruct us. Our Singapore revenue indicates the billing address often for subsidiaries of our U.S. customers. The associated products are shipped to other locations, including the U.S. and Taiwan, not China. NVIDIA was already, though, trading lower, as you mentioned, after announcing a $5.5 billion Q1 charge following new U.S. government export restrictions on the sale of these advanced chips to China. Evercore ISI actually put out a really interesting note this afternoon saying the CFO of NVIDIA doesn't see much market for those H20 chips outside of China, and that the production lines use completely different manufacturing processes, so they can't really be repurposed for Blackwell chips, which is this upcoming iteration. And so that's why NVIDIA had to write off so much, $5.5 billion. Morgan Stanley indicates these license requirements will reduce data center revenues by 8 to 9% over the next few quarters. AMD, lastly, also warning of an $800 million charge due to these license requirements, with the assumption that more are coming for Broadwell, Marvell. Overall, that's why you're seeing the chip sector down today. Scott?
Yeah, I would also say, you know, when you, in this report that you just did, talk about, well, it's the H20, it's not a big demand outside of China. I feel like a good part of this story, it's not even about the chip. It's about the process. It's about the willingness of the administration to get in the business of NVIDIA. It just points to other things that may be down the road.
Well, especially since NVIDIA was convinced that the H20s weren't going to be banned. Keep in mind, just a week and a half ago, Jensen Huang, the CEO, was at Mar-a-Lago, had dinner with President Trump. And the assumption, NPR even put out a piece, the assumption was, okay, NVIDIA's okay. They can continue shipping the H20s. And then all of a sudden, as of last Wednesday, April 9th, then they were told, no, forget it. You're going to have to fill out these license requirements to ship all these chips to China, and that could take anywhere up to 12 months, which is why there's such a negative reaction, estimates coming down, price targets coming down, because this is not a ban, but it's being treated like one because it's going to be so difficult to do anything with these chips now.
Yeah, thank you, Christina. Christina Partsinevelos just bringing us up to date on certainly the stock of the day, one that was getting even worse as we approached the close. What do we think about tech? I mean, I said the Nasdaq's just getting crushed.
Yeah, it's in the near term, it's so difficult to know. I mean, I just don't know with idiosyncratic news like we've just heard how to handicap that. I just don't know exactly what will happen along tariff lines, export bans, et cetera. Here's what we do know. The COVID-19 pandemic, yes, we can go back that far, I think. The COVID-19 pandemic showed everyone, normal people, why supply chains are important and why protecting them is important. That there was this just felt reality that if you couldn't get a computer chip from Taiwan, you couldn't buy a car. Then just a couple of years later, you have ChatGPT and artificial intelligence making this so clear how important of a global economic and national security situation we have in the technology supply chain. And on top of that, as much as we, the United States, China, whoever, might want to be completely self-sufficient in that supply chain, it is completely impractical in the next 3 to 5 years. The U.S. has runs chip design. China runs testing and packaging and some materials. Taiwan is excellent at making the chips. Europe is excellent at making the equipment that makes the chips. We all rely on each other, and so the investment that is going to be required to really hone in on this economic and national security issue just cannot go away.
Okay. I think you just made one of the most important points of the entire day. We learned this once, okay, what disrupted supply chains do to inflation. Other things were at play, which probably accentuated where inflation went to. You don't have the level of inflation that we got to without the disrupted supply chains from the pandemic. We're going to do this again? Are we going to play this game again? I understand the idea of trying to bring critical manufacturing of chips and things like that to the United States so we have less reliance for national security and other reasons. That takes time. So are you going to blow up the global trading system today in a way to get there and risk the idea that you lose control of the inflation picture yet again, some 3 years or so since we learned our lesson the first time? And the market's going to have to live with the ramifications of that experiment. And that's what this is in part.
I think that's a great summation. What we're beginning to hang our hat on we're listening to Scott Bessent, and he's starting to use the words like, we'll get certainty, we'll get clarity, which means that we should start to see progress. If we see progress between the U.S. and Japan on tariffs, then I think we'll see that template. If we don't see that progress in the next 1 to 2 months, it's a difficult environment. What we think is going on, and I think we can all agree, and a lot of my clients say the same thing, we agree with the principles, we don't like the execution, right? And so what the administration is trying to do very awkwardly is say, okay, this is about national security, whether it's technology or otherwise, we want that built with a friendly. Friendly is either in North America, parts of Asia, in the EU, but it is not China. And what we're trying to do and what we're saying is China is that existential threat. The issue, and again, you said it very eloquently, is there's a tremendous amount of concern about supply chains, right? If we do this, and the administration seems to be learning on the fly, if they pull back, we can pull out of this. But if they get a lot more aggressive, yes, you're absolutely positively right. We're going to have some big, big problems.
You can only front load purchases, big ticket ones, so much.
Right.
Maybe you're not in a financial position to buy that car today that you intended to buy tomorrow. But I do remember the sort of effects and impacts that happened during the pandemic, where dealerships were asking for prices that were 10 to 20% above MSRP.
But
why? Because you couldn't get enough cars.
But the one thing that is different is there was transfer payments from the government to individuals. They had a ton of cash. We used to joke around to people that if you raise prices 25%, people would say, I'll take 2, right? The consumer is in a different spot at this point in time. So we don't see that kind of demand going forward, which means that any inflation I don't think is going to be sustainable. And again, we have to get back to something that's very, very difficult to handicap. How long will these tariffs be in place? How much is it a negotiating ploy? And how much progress are we going to make over the next 1, 2, and 3 months?
All right, we're about 35 minutes past the hour. Just to bring everybody up to date, NASDAQ is the big decliner today. It is down by a touch more than 4%, near 700 points. The Dow, for that matter, is down almost 900 points. That's 2.2%. You're at an elevated level still in the Dow that a 900-point decline ain't what it used to be. But you're still down 2.25% nonetheless. Guys, thanks for helping us get through this. I appreciate you so very much. Lauren and Chris, we'll see you soon for sure. Let's bring in Mohamed El-Arian now. He's the Chief Economic Advisor at Allianz. I appreciate you reaching out and your willingness to come on and discuss this. What is your takeaway from what Chair Powell said? Because it has clearly had a negative impact on these markets.
It has, because he said very clearly there are no good news cuts anywhere on the horizon. That is, cuts warranted by low inflation. There are no bad news cuts on his radar screen because he's worried about persistent inflation. And then he brushed aside completely what I call the awful rate cuts, those that are prompted by market malfunction. So across the board, he said, look, there are no rate cuts coming for now. The stock market heard him. The bond market seems to ignore him, but I don't think it is ignore him. I think the bond market is realizing that this economy is going to slow quite a bit. So while I agree with Steve that it's unlikely you get a June cut, what you're seeing in the bond market is real concern about the growth outlook, and that's why you're down 7 to 9 basis points in maturities up to 5 years.
Do you think the Fed's going to be, I know what he said, and I hear you, and I think your explanation sounds right. That's all fine and good until something actually happens. Are they going to be forced to do something, do you think?
So there's a game of chicken going on right now between the administration and the Fed. The Fed does not want to cut. It thinks that the policy problem is elsewhere. The administration would like the Fed to cut. I think the only horizon, the only scenario you get a Fed rate cut anytime soon is if we get close to what we had last week, which is bond market malfunction. You know, Scott, more than anybody else you know, there's a big difference between unusual volatility and malfunction. Unusual volatility you can get done at a price. You may not like the price, you may not like the bid-offer spread, but you'll get done. Malfunction is you can't, and therefore what do? You go do something else and you spread the disruption through the market. So only if we get back to where we were last week, market malfunction, will we see the Fed act anytime soon.
Right, but did we do anything to solve the method, so to speak, to the bond market madness? We really didn't. We settled things for the moment, but I would suggest that I'm not necessarily sure that the mechanism that led to that has been cleared up in any way.
So it hasn't on the tariff side. It hasn't in terms of foreigners selling, but it has on the Fed side. Susan Collins came up on Friday, and she said very clearly, if there's malfunction, we will intervene. So, you know, the market heard something that it wanted to hear, which is more durable than the 90-day postponement, and that's more durable than what else it heard about foreigners are selling bonds.
I mean, we just wanted to know, I think, at that moment that the cop was on the beat, that they were ready, willing, and able, even though it's obvious that they would be ready, willing, and able to do something. I think hearing it out loud was a bit of a security blanket of sorts at that moment of need for the market, whether it really represented any, you know, great leap forward or not.
I agree, and I was surprised that Chair Powell brushed aside the question on market malfunction. He just brushed it aside, which I don't think was such a good idea. You need to hear, as you say, that the cop is on the beat.
Mohammed, I got to go. Thank you so much for coming on. I appreciate you. Mohammed El-Arian, jumping on to help us understand what's happening within these markets, reacting clearly to what the Fed chair had to say. We're going to take a quick break. When we come back, the former Dallas Fed president, Robert Kaplan, tell us what he thinks the Fed's next move should be. We're back after this. Well, it's been a very busy news hour, as you know, and I have some new news for you, something we'll call new on Closing Bell exclusively today. It is regarding Bill Ackman this afternoon, his Pershing Square revealing today in a 13F filing a 4.1% position in Hertz as of December 31st. That news sending shares sharply higher in the session, as you see. I'm told from a person familiar that the stake is actually much, much higher than that, about 19.8% through shares and swaps. Pershing, in fact, now the second largest shareholder in Hertz. I'm also told that Pershing received a confidential treatment provision from the SEC, which allowed them to delay the filing beyond the normally required reporting period, which gave them the ability to accumulate substantially more shares since the end of December. Worth noting, too, that not all of those types of SEC requests get approved. They did. Hertz has had a lot of issues, as you probably know, over the past several years. It fell into bankruptcy in 2020 during COVID, then emerged with a new management team and a big bet on EVs. It bought 100,000 Teslas, but ran into unexpected issues with the fleet and its strategy. It later sold a third of the fleet, but declining Tesla prices led to much lower resale and residual values. Hertz still has some Teslas in its fleet and hasn't fully abandoned the EV strategy just yet. Now, here's where Ackman's bet comes in, according to a source familiar. Since Hertz took the Tesla hit, the company has locked in replacement cars at much more favorable terms. There's also a tariff play, believe it or not here, on the belief that they'll only increase the residual values of existing vehicles, since used cars aren't hit with tariffs. So between the new management team and the prospects of generating a material amount of cash flow, Pershing is said to be very optimistic of a continued turnaround. We've reached out to Hertz. We'll let you know if we hear back, but there is that stock moving substantially as we approach the close today. Up next, much more on this big market sell-off. Market Zone's next.
Want to thank everyone for tuning in to today's show. We had a great show. Again, we call out our trades at 9:35 in the morning. We start at 9:25. So make sure you are subscribed so that you'll be notified when we go live. Again, today's trade worked out beautifully. We called the 530 put, taking it all the way down to 529. I'm sorry. We called the 530 put, getting in at the 529. 4 beautiful bounce gave us a perfect opportunity to get in. First profit target was the 524. We hit that and bounced from that, and then we went on to the second profit target of 521.4. We actually went lower than that to the 520.3, but again, nothing is exact, everything is area, but nonetheless a beautiful drop from the 530 put all the way down to the 521, a nice $9 trade called out in the wee hours of the trading day beginning at 9:35. Again, we thank you guys for tuning in. We look forward to doing this again with you tomorrow, God willing, inshallah. So please hit the like button and the subscribe button. That's all we have for today. Bye for now. Be well.